Good morning, everybody. Welcome to the Flow Show, Friday, the 8th of November. Thankfully, Friday. What a week it's been. Knackered. Don't know about you guys and girls. Got a special guest on today. Just want to do a quick sound check with my old mate, Harry. Are you there, mate?
Don't know about special, but yes, I'm here. You can hear me.
Yep, got you loud and clear, mate. Good morning to you, sir.
Good
You're
morning.
probably as knackered as the rest of us at the moment.
Yeah, big time. But you're still here.
Yep, good. Yeah, markets are still here. We're still trading. Right, I'm going to bring Harry in to the conversation over some of the stuff that's been going on, but we'll get through a few of the headlines first that have been going on. Firstly, over in China, we've had the BODs over there, lawmakers approving this big local government debt swap plan that's been ongoing. So all these plans that they announced previously, they're all ratifying and putting into action now. Some 6 trillion package that's going to be going into local debt to help the property market and this, that, and the other. So there's a lot of headlines going up about China stimulus, and it's even started to confuse me because some of the wires are printing stuff as if it's new, but it's not. It's actually putting up what they announced previously and putting it all into effect. We've had the Ministry of Commerce out in China as well, surprisingly or not, just after Trump wins the election in the US. They are making progress in talks with the EU on electric vehicle tariffs. Surprise, surprise. That's what the Chinese side have said, that they've made progress in those talks. EU, a little more pragmatic, have said they've had technical progress in these negotiations with China. But we'll see what comes of that. The PBOC have been on the waffle as well. Usual stuff. They're going to maintain their one exchange rate reasonably stable. They're going to increase the intensity of monetary policy adjustments and apparently going to prevent one-sided views on the yuan becoming self-fulfilling. That's not a direct indication that they've got any levels in mind or areas where they're going to start pushing the other way. They've already been intervening this week, but they're keeping the warnings ongoing. Over in Japan, Finance Minister Kato said we will closely monitor the impact of Trump's policies on the Japanese economy. Then said he won't comment on FX levels, but then threw out the old warnings. We are watching carefully, blah, 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 blah. Over at the Bank of England, they kicked off by cutting rates by 25 pips to 4.75%. All in line as expected. The vote 8-1 as expected. Bailey said they can't cut rates too quickly or by too much, and that rates are likely to fall gradually from here. Their forecast showed CPI going up in 1 year's time. It's at 2.7% versus 2.4% at their last monetary policy report. In 2 years' time, they also see CPI up at 2.2% versus 1.7% previously. Growth for this year, not that it matters, as we've only got 2 months left, got revised down to 1% from 1.25%. 2025, though, got hiked to 1.5% from 1%. In those forecasts, they still see sticky wages. Around the budget and all those fiscal measures, what it's likely to produce, they see it only adding 0.5% to CPI at its peak. So over the course of the next 5 years of government. In the presser, not an awful lot going on. There was talk from Ramsden saying we are seeing a lot of movement in the market rate curve due to global developments and domestic ones. Bailey gave us all a trading lesson as well yesterday, saying that there was a lot of longs in the short end and they all got stopped out, apparently. So he's obviously got his finger on his trading screen as well. He also said about the budget, I do not think it is right to conclude that the path of interest rates will be very different due to the budget. So, Harry, pretty much what we thought was going to happen. No real pushback against the moving yields by him and taking the budget in his stride, but it's still a slowly approach, mate.
Yeah, in terms of the Bank of England, I don't think we really expect them this close or so soon after the budget to really be that reactive, just by past history. So, well, unless you take the trust effect into account. But so I think they'll take a step back and have a look at everything that's been announced and the fiscal, and they have done, and deduced that, at its peak, we're going to get that 0.5% rise. So I don't, and in terms of the yields, I really don't think there's been enough of a violent move in yields. It's been an orderly move, so therefore there's no real need for them to get involved and to upset what is a free market effectively. So yeah, in terms of where it leaves the future rate path, it's still up in the air. I think you've got the divergence here with the ECB, for example, which is sounding a little bit more dovish on that front, and then it's more aligned with the FOMC in terms of taking a more cautious approach and data dependency. So yeah, ultimately it was a nothing burger in terms of a rate decision. It will help out mortgage owners and the like, but ultimately, will it do enough to spur the economy? By the sounds of it, looking at some of the agencies out there, not on its own. We are going to need, I think, further rate cuts down the line, when and where they might be, to help push the economy forward. Again, I've got a note from the NIESR, National Institute of Economic and Social Research, that said subdued growth in a challenging fiscal landscape is how they term their economic outlook for the time being. So yeah, I mean, from Bank of England, I think the market still expects more to come, but with sticky inflation, sticky services, they're going to take a cautious approach.
Yeah, where do you think the tipping point is? Because obviously that budget last week, loads of taxes for very little reward,
Mm.
effectively. It's not a big growth environment that they're fostering here. So, the economy's already, bouncing along the bottom. We're not going great guns. We're not as bad as Europe, perhaps, but we're not
No.
outstripping the rest of the world. Is there a fine line between when that might tip into more negative and then the BOE are going to have to react faster?
Well, we've had 8 months of consecutive growth or flat, no growth or flat, or small growth. We haven't dipped into contractionary territory for 8 months. You've got to take the wins where you can, and that's one of them. At the start of this year, people were looking at potential recession or continued, a global recession, if you like, and a global slowdown. It hasn't happened. So you take the graces there where you find it. In terms of the tipping point, I think it still lies with wages. Wages are still running a little bit on the hot side, and I don't think the budget's done anything to kind of help that in any way. We've seen some wage agreements between unions and the Labour Party already. So I think that to me, I still think that's where the driver will be, that, and obviously the services, as we've mentioned, and where that fits into all this. But activity-wise, at the moment, again, like you say, we're bumbling along the bottom, and there's nothing to suggest we're going to do anything other than that over the course of the near term anyway. We have to wait for rate cuts to take effect. Normally that is a lagged effect. So we look at it again next quarter, as they will, and I think they're February is the next NPR, to see if we've seen any kind of benefit from the past rate cuts, and whether they need to stoke the fire a bit more
Yeah,
thereafter.
yeah, I agree with that. And like you say, yeah, I think these tax hikes, particularly national insurance, we've got to see that impact on wages and what firms are going to do, whether they're going to, offload staff to cover the cost, or not go with higher pay rises next year.
Yeah, well, I think there's a case where they won't fire staff, or they won't be hiring staff, and that in itself will obviously lift the unemployment rate to a degree. Yeah, I don't know. We'll see proactivity in terms of people firing staff over this. As I said, I just think it puts a hold on that hiring intentions down the line, and that will have its own effect on the labour market and on the economy as a whole anyway. But if we do start seeing a bit of growth, it'll cover over the cracks, and it will be covering over cracks. It won't be, in my opinion, anyway, it won't be getting to the root of the issue trying to build a decent foundation. It will just be, lipstick on a pig.
Yeah, good say, mate.
Yeah.
The other one's polishing a turd, isn't it? Right.
Okay.
We're going down that road. It's Friday. We're allowed to go off reservation a bit. But yeah, the job situation could be a bit like what the US is seeing, and a lot of Fed members saying that they're not seeing job losses. They're just seeing a slowdown in hiring, and the same thing is probably going to occur over here. Not that we can judge it, of course, because the ONS still trying to get their house in order regarding jobs data.
Yeah, that's helpful.
And even he was talking about it yesterday, that monetary policy goes on irrespective of what the ONS are up to. And I have no idea did you have any idea when they're going to fix that crap?
No, but I mean, to be fair, I mean, the Bank of England had its own metrics it uses alongside the ONS. I know they don't always get along in terms of or agree upon them on the gauges and metrics that they use. So I'm pretty sure the Bank of England relies on its own calculations anyway, and some private survey measures for its assessment. As for the ONS, no, it's one of the things. It's on my list of things to do, to get in touch and find out if they've got any plans to correct it. It's a headache for them, for sure. It's an ongoing one. This isn't particularly new. I think they've had issues with measurements for years now, so it's not a particularly new phenomena. But they do need to get their heads around it and figure it out, because it's leaving a black hole really in terms of we could come back and see a load of revisions in the new year that tell a completely different story. I don't think it will, but it could do. And if that's the situation, where does policy sit from there?
Yeah, no, absolutely. And I wish you all the luck with that phone call, mate. Hopefully you get somewhere with it.
Yeah.
Right, let's get over to the US. We did get a bit of data out of there. Nothing hugely important. Where am I going? I'll find it. Thursday. We got jobless claims, and nothing burger as well there, 221. And this one really hasn't even been really affected by the hurricanes either. We had one little wobble one week, and it's been okay ever since. So moving on from that. We did get some Q3 non-farm and unit labour costs, which is something the Fed does keep an eye on.
Yeah.
Bit of a wobbly on this one. It went up above expectations, the labour cost, 1.9%. But the prior got a massive revision from 0.4% to 2.4%. So it's actually a negative compared to the prior quarter, whereas before the revision, it was a positive. So I don't know what they make of that one.
Again, you've got these again, and the US has its own issues with its measurements of the labour market anyway, as we know. So yeah, it is a bit of a mixed picture. I'm no economist, so I couldn't give you a great big rundown on that. But yeah, I mean, it's just one of the things that feed into their assessment. They seem quite happy that the economy is in a more balanced position. I mean, they've got their dual remit of inflation and employment. So for them, the Fed, appear happy that that's in a more balanced environment right now. So they may, and this is backward-looking data. So effectively, do they really? Not care is the wrong word, but are they looking at other measures at the moment to gauge where they need to be? But yeah, as I said, I'm not a massive one. I'm not an economist, so for me, how you balance that is a tough one.
Yeah, bit of a difficult one, but yeah, it's not going well. It is going down, but it wasn't going down. But
well, productivity. So productivity was up 2.2%, wasn't it, over the quarter? Is what they said there. And I think there's been, if I can, so increased. In manufacturing productivity increased 1%. That's good. Again, this is all predicated on what Trump does when he comes in. He wants the America First approach. Does he build an investment into manufacturing, into industrials, and boost it that way? And then what ramifications will that have on imports and everything else? So to me, it's going to be it's a work in progress, I think, and that the dynamics will change depending on how quickly he starts, bringing in his plans.
Yeah.
It's going to be one of those things. We just have to wait and see how much he does, how quickly.
Yeah, it's almost like it's sort of taking a clean slate for the data for when he actually gets in the chair, and then taking it from there. But as we know, central banks have got to move on what they're seeing now,
Yeah.
more so than what they see in happen in 6-8 months' time. So
Well, and what
yeah,
you like to see between now and January is the current administration try and ram through as much as they can in terms of their spending pledges, as they've said with Ukraine, in terms of trying to make sure they get all the stuff that's been pledged to them. They're going to try and ram through, I think, as much as they possibly can before Trump comes in and resets everything. So
yeah,
again, I expect a woolly outlook to all this in the near term, because there's a lot of inputs at the moment, and we're going to have to wait and see how that clears out from January onwards, really, after the inauguration.
yeah, exactly. Agree with that as well. Well, just in case you been off or you've been living under a rock, we'll go over what the Fed did yesterday. They cut rates by 25 pips as expected. Now, there was one glaring change to the statement. Well, we look glaring at the outset. They removed the line that said they had gained greater confidence in inflation moving sustainably towards target, which a lot of us took as a bit of a hawkish tilt, i.e. they aren't as confident now, meaning that they may not cut rates as much. So a few of us jumped on some dollar longs there, and up the dollar went on that. But later in the presser, he was asked explicitly about that line removal and what it meant. And the reporter said, "Does it mean anything important?" And pretty much Powell said, "No, it wasn't. It wasn't a guide to anything. They just don't want to do a lot of forward guidance, and they saw that line as too much forward guidance, which makes you wonder why it was in there in the first place." But so that saw a little bit of a reversal in the dollar bid that we saw just on that line. Otherwise, the rest of it was unchanged. They said, Powell said, if the economy remains strong, but inflation is not moving to 2%, they can dial back policy more slowly. That was a little another undovish comment there, but otherwise, it was business as usual. They're going to wait, see what the economy does. They can go faster, they can go slower, but there's no worries at all. He was asked if he would leave if Trump asked him to which he said no. But there's already been a story out. I think CNN had it that Trump wasn't going to ask him to leave anyway. So carry on as usual for that one. What was your take last night overall, mate?
Well, I'll start with the removal bit first. His term finishes in 2026, and I'm pretty sure someone would have, not that it matters sometimes, would have versed Trump on the legalities of it, and the fact that you can't sack him, and he can step down, but he can't force him out. Hence the independency of the central bank. So I'm pretty sure that was a moot point anyway, and it was just worth addressing and clearing up from Powell's perspective, and he was quite definite on that. On the omission of the greater confidence phrase, I mean, I've read a couple of bank research pieces that said, look, we expected the FMC to remove the reference because of stronger than expected September inflation prints, but they were surprised that it no longer mentioned that the committee is confident that inflation is moving sustainably towards its target. They said that was a bit surprising, but like you said, Powell wanted to quickly brush that under the carpet and say that there is no signal in that, and so you take them at their word. If that's the case, fine. We do know that inflation's been sticky. We do, there is this. I mean, other than the uncertainty of a new administration, we have seen elements of the US economy that have meant persistent inflation or persistent cost prices that are still there, and I think it would be remiss if they didn't pay some notice to that. I do think, because we've got a solid economy, 2.8% growth rate, and everything else that's going on, I'd be worried if they overlooked that, because they have, let's get it right, they've overlooked inflationary issues before to their own damage. So therefore, I'm not overly worried about that phrase or dropping on that phrase or whatever. I still think they want to cut rates. I still think they're on that path at the moment. 2025, again, you can make your own bets as to whether we'll see 150 basis points of cuts next year, 175, I think, which is where we're at the moment, of cuts. Because, as I said, once Trump gets in, I'm not saying all bets are off, but it'll be interesting to see how much that stokes activity ultimately, and how quickly that feeds through into policy. So it's just one of those things. I think it's right to be open-ended. I think it's right to leave the door ajar to December, but also to remind people that it's not an autopilot in terms of policy.
Yeah, yeah, and he also did a bit of a brush job on the rally in yields as well. Unsurprisingly, I mean,
Yeah.
we've been saying this week, or I've been saying this week, this was always going to be a meeting he wanted to get through really quickly with the election first and foremost. Get through it, answer, not get put in any awkward positions, keep the path of rate cuts going, and move on away from the election. And he did a good job brushing everything under the carpet. In terms of anything that could have tripped him up.
Well, yes, let's do that. That's, they don't want to get embroiled in all that sort of political stuff, and where possible, they will always try and keep their heads down and get through it, because they don't want that anything thrown at them on that side. They inevitably will, but they don't like it.
Yeah. So I've got a question for you. What are you making of the market in general, sort of bringing down their expectations for Fed cuts? Are we seeing a situation where they're getting a little too undovish, too much undovishness going on there? I think we were down, or December got cut to about 67% or something chance of a cut. And, you got the likes of JP Morgan thinking that there's cuts now going to be just every quarter starting in March. Do you think the market's swinging too far towards the hawkish side compared to what the Fed has said they're going to do?
Inevitably, markets will swing around before they find the price, because that's what markets do. It's a price discovery, phenomena. That's what happens. But if you go back to this time last year and the amount of cuts that were pricing into the curve,
Yeah.
that looked overdone even back then, really. And so I'm not overly surprised that they've taken some of that off the table. You go back to Citi, and I point out Citi because they were the most outspoken, I think, in recent times about calling for. They were looking for 150 basis points worth of cuts this side of Christmas, back in, I think, July, end of July, August time. So I'm not surprised people are paring back those expectations, and I think it's right that they should, really, because we don't know now. I mean, if Biden or Harris had retained office, you know what you're going to get, more of the same, really. But we don't now, and this is the beauty of Trump. For us as news providers and aggregators, it's you just don't know what's around the corner. And for markets, I suggest that we are in now for 4 years potentially of opportunity in terms of trading opportunities, because you don't know what's around the corner. So I think paring back on some of those, that rate cutting bet, because also, if you believe in what Trump is saying, he's going to be injecting the impetus into the economy to get growth up, and to raise productivity. So do you need as many cuts anyway, if that's the case? And we'll wait and see. But it's a logical thinking, a logical step, I think, to pare back some of that and just sit on the fence, maybe.
Yeah, exactly. And that brings us on to a good point I wanted to discuss with you as well. But just for anyone who doesn't know who you are Mr. Live Squawk, a service I use.
I go by Harry, though. So
yeah, Harry, Mr. Live Squawk.
Yeah,
and for the viewers here, Harry runs Live Squawk here, which is probably the best squawk service out there. Always on the ball, always quick to the headlines. Great website as well. So if you want to check them out there, you know where they are at livesquawk.com. But the question I wanted to ask is about Trump trading. I joined Truth Social the other day. You've probably been on it quite some time, I should imagine, for the course of your business. are we going to be back to Twitter trading, which we did through the first 4 years of Trump's presidency? And have you looked? I had a little quick look. Have you looked to see whether he posts first on Truth Social or Twitter?
That's good. It's a good point. I think listen, until Musk took it back over. Obviously he wasn't anywhere near it. I do think he'll try and promote his own site first. So you've got to be looking for breaking headlines on that. But he's the president. He's got to make. There has to be a level. And I think the first time round, it was a novel thing for him. It was just like, oh my God, I'm here. It was a toy as a kid in a toy shop. I think there'll be a level of a higher level of responsibility. This is purely hope over history, and I think we'll see announcements through the proper more through the proper channels than simply on social media anyway. He's got 4 years. He's got carte blanche now. Whereas before, I think he was stymied by officials and the US equivalent of civil servants, effectively saying you can do this, you can't do that. So he took to social media because that's the only way he could get his voice out. I think there'll be a slightly different approach, a slightly more professional approach. I think this time round, personally, to how he breaks news and everything else. And I'd also think, but then, with Musk on board now, I think you'll always get the odd droplets out on social media. I just think there'll be less reactionary stuff from the president-elect this time around. Oh, well, I'd like to think so, just because he may have matured a little bit, really. But so it's always worth. Listen, it's always worth arbitraging and seeing where these things happen, and you've got to cover all bases. I just think from the standpoint that he's not new to this. This is now his second term in office, his last term, and he's now got a mandate, an absolute mandate to do as he wants. He might not have the House in its entirety, but he's got a pretty good hold on Congress at the moment, and therefore he can use communication channels, the conventional communication channels, to get the point across because he hasn't got to try and circumvent officials elsewhere. So that's my personal view on it. But yes, we'll be all over it to make sure we get it at source wherever possible.
Yeah, I'm sure you will. And I actually hope you're wrong because getting policy moves via Twitter was brilliant in those 4 years.
It was fantastic. For us as a company, this is what we do. It was brilliant for us. I'd like to think you don't get for what everyone thinks about President Trump and his people. He does surround himself with some clever people. He can't be stupid because he's made it to the White House twice now. He's a very rich man. However you think he gained that wealth, he's retained it. You've got to learn things. You must learn to evolve. And if he hasn't learned, it's going to be worrying. But I think he has. I think you'll see a different profile of Trump. This is a different Trump profile than last time, I think, because I think last time he probably thought he squeaked it. This time, it was resounding, and therefore he can then push the message as he sees fit.
Yeah, I think it's going to be a fun 4 years ahead, and hopefully plenty of trading opportunities as well. While we're on Musk, the Mexico Economy Minister Ebrard came out saying he will try to meet Musk soon to determine whether they're going to build a possible car plant in north of Mexico. So I think Musk's involvement in this election is going to be potentially good for him in terms of business wise. And if he gets a few sweeteners from Trump, Tesla's going to the moon probably in the stock price.
Yeah, I mean, Musk has had it off here. I mean, he backed the right horse. It's so much in politics when you look at those that finance these campaigns and everything else. It's all about backing the right horse, and he did, and you get rewarded for that in American politics. Over here you do as well, but in American politics you get rewarded for that, and he will be. And this tariff situation with China with Europe is like you said, there's no massive surprise now that China and Europe are going to get around the table and try and resolve this, because they now see across the pond this looming threat from the president-elect, and they want to get ahead of it, or they should be thinking that way. Or if they do, they should be. And so I see that getting resolved, because the competition is Tesla. The competition are US companies, and they need to get their house in order. Europe, especially, look at the German companies out, the automakers at the moment. They're all, they're dying in their own country, let alone overseas. And Mexico, as a neighbour, as a major car manufacturer as well, will also want to try and resolve matters and make sure that the USMCA, is it USCMA or USMCA?
USMCA, yeah.
Is fit and proper.
Yeah. And he said he's going to negotiate that. I mean, I've been saying it for a while now that obviously he's been coming out with the big threats of tariffs, 200% on Mexico, and this, that, and the other on China. And everyone since he's won has been spouting off about it. We had ECB members spouting off about it. Pretty much every country, we don't know what's going to happen, and tariffs are bad, and blah 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 blah. And I've been saying that this is all part of his negotiation plan.
Absolutely.
These big threats. It's got everyone running around panicking now, and that's going to bring them to the table. And I think it's another one of these situations where you've got half the world thinking this is bad, this is inflationary, there's going to be big tariffs, it's going to hit growth, blah blah blah, and it's not going to get to that point. They're going to get around the table, and it's going to be something in between what Trump wants and what the fears are. So I think for trading going forward, for markets going forward, you've got to have that in the back of your mind. It's not going to be as bad as everyone else makes out, perhaps.
Well, this is classic deal making 101, especially from Trump. And you see it. You push too far. You ask for too much, and then you're happy to take a little bit less. On the Mexico situation, look, what's his biggest policy? What won him the election? Immigration. Repatriating foreign migrants, really illegal foreign migrants, as they call them. That is a big lever in against Mexico. So you can already picture what he's saying to the Mexicans about, look, we need to get on top of this. This is what I've been brought back to the White House for. If you want a decent deal, I need your help to stop this border issue and make you look good. And it's stuff like that. But this is all deal making. This is all how he works. It's on leverage and everything else. And so I'm not surprised. And I think you're right. I think everyone's scurrying around because it's everyone else's worst nightmare. The establishment don't like surprises. And in Trump, you've got one great big present of a surprise, and at every turn. And so they have to get themselves in order. They've been complacent, I think, with the Democrat party, with the current government rather. And I think that's ending, and that complacency is ending, and now they're going to have to sort themselves out. So we'll see what that does. I mean, you got Germany and like the elections coming up as well, and so Europe is got enough on its own shoulders that it has to sort out at the moment in the immediate future if it wants to be in any fit shape to try and take on the US.
Yeah, absolutely, mate. Absolutely. Right, well, I'm going to get stuck into some price charts now. I don't know if you want to hang around for that, mate, or if you've got other stuff you need to be getting on with.
I'm on the school this afternoon, so I've got to head into the office and prep for being on the microphone later on today.
Oh, good stuff. We get to hear your voice yet again. Well, thank you very much for coming on board, mate. We'll definitely get you on again. And as I said to the viewers, check out Live Squawk, livesquawk.com. Check out the Squawk service. We do have the newsfeed plugged into our platform as well, so you can catch at least the headlines there. But apart from that, thank you very much, mate, and speak to you soon.
Thank you very much. Thanks for having me.
Cheers, mate. Bye-bye.
Bye.
Right, well, let's get stuck into what's been going on in prices. And the main theme I want to talk about today, and we've been talking about this a lot in our chat room, we've had this big week. We've had these big events, and we need to know where we are now. And I'm seeing a lot of patterns, a lot of similar patterns in a lot of markets at the moment. And these patterns are important for assessing where we are right now. So we came into the election, we had the big election reaction. As you can see there, I'm just taking euro dollar as an example. We had a rally yesterday. That rally ran into a bit of trouble at a tech level, bottom of my zone. You know this zone very well by now, which is roughly about 50% of the election move. So when we had this move down, okay, the markets had its reaction. Now it goes to what do we do now? Okay, we've had the expectation, the outcome that perhaps we were trading previously. What do we do now? And this is, as I say, one of these patterns where you get a correction to the reaction, if you like. But that correction's really pretty much only gone 50% of the way. So it hasn't unwound the whole reaction. And that tells me that the market is now in a bit of balance. We're still in what next mode. The election stuff is now fading into the rearview mirror. We now need to look forward to what happens when Trump takes the hot seat and starts putting policy through. But that's potentially not until January, you know, suffice for any headlines we get or anything that comes on the news. So here we are, pretty much bang in the middle of what we've seen this week. Market is in balance, okay, right now. I don't think it's too long. I don't think it's too short. You might say longer term, it's still a bit short, euro dollar off the highs here. But at least in the short term, we're in a bit of no man's land at the moment. So what do you do from here? Well, what I'm looking for is whether perhaps, we're going to continue this move because it hasn't really shown signs of breaking. I'm going to ignore a lot of this that happened because, you know, it was in the run-up. NFP, we had the data, blah, 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 blah. So for me, this trend is still in play. This downtrend is still in play. What I think we're probably going to happen now is that maybe we're going to see a bit of a range set up from now. So I'm looking at this 108s, 107s as the main range. And then we've got these little extension points, 106.80s, 108.30s. That's going to be my guideline moving forward. I think we're going to now need the next catalyst to come through for the market to make a meaningful move, whether it's up or down. But we've got this range to look at. And so you've got your points on the chart where you can say, if we're here, then we're likely to do X, Y, Z. Or if we're here, we're going to do A, B, C. What's significant now? Through all this noise, the one level we're holding is 107.60. Okay, right in the middle here. It was a level I flagged on the way down. It was a level after we broke for a bit. Then we broke above it, and now it's a level of support at the moment. So this is really, again, it's a bit in the middle of this move here. So this is really your pivot point. If we're holding above here, then there's a chance we're going to push higher, maybe get back up into 109s. Who knows? If we're below here, then it's going to keep the pressure on the downside. Then we need to see what happens back down at 107. If that holds a retest after we've had all this election noise, that's going to be a potentially significant move because it's a big level. Okay, I don't listen to big levels when we're in the midst of something like an election or NFP and we're close. But afterwards, I want to see if it shows up again. So you've got your levels, you've got your range. You can have your bias, whether you think the dollar's going to the moon or it's going to shit, doesn't really matter. You've got your numbers on the chart that you can look at and say, right, well, if we're staying above here, then that keeps the upside in play. If we're below here, keeps the downside in play. And then you can trade off all the other levels that we go. This 108, 30, 70 level, it's a big one. You know, unless we can hold above the top end, we're not going to be moving to 109 or moving even higher. Okay, it's tried, we had a go, it failed. Okay, again, this was an election move, so it's a bit of noise. And now you see what happens after. Right after yesterday, we pretty much top out at the bottom of the zone. So this is still a big area, and we may or may not have resolved it at the moment. So all these key points you just need to add up. Exactly, Brian. I said tech wasn't going to count for anything on election day. just like it doesn't 5 minutes before an NFP or something like that. But it's afterwards. So you can see levels breaking over big volatile moves, but what does it do afterwards? Does it respect those levels or does it not? I know, Dereg, before you pop up, I'm going to look at gold because that's doing pretty much exactly the same thing as well. Election reaction, pretty much undo 50% of the move. Now we're doing a bit of a pivot around this 2685 level. Okay, so we had a bit of data. We've had all the events. You know, 2685 was a big level to look at. Didn't do anything on the way down. Neither did 2670 on the way down. But afterwards, 2670 did have a bit of resistance against it. Now we've broken back above, gone through here. So this line's a bit wishy-washy at the moment. But again, you can use it as a pivot point for this move here. Okay. If we're going to hold above it, then that's going to suggest that we got a bit of upside to come because it's going to build a bit of a base there. Then maybe we push up through 27, 12, 13, this old level. Maybe then we get up back up to 27, 30s, 40s. But if we can't, if we start holding below, then that's going to keep the pressure on. And then we see again what happens 26.70, what happens down towards this low again. Now you'll remember that all these lines I've been putting on my chart are really short term. They're just the price action as we were making these moves. But you can see how some get respected, some don't. You can take them off, add new ones on, whatever you floats your boat. But these are levels that I think, right, it did something here. Is it going to do something again? Well, here it has. Same with all these levels. So this was a lesson I was trying to give when we were making all-time highs, all-time highs, all-time highs, and we had no prior history to build on. You just let the price action show you where the levels are going to be. Okay, so like I said, this is a similar pattern. Reaction, give back on the reaction, what next? And then you can look at your levels and see what's going on from there. So I don't know. It's a bit of a coin toss now whether we go back up or go back down from here. But I can say I'm gonna base the result on what happens at 26.85. If it starts holding above, then we're going higher. If it don't, we're going back lower, and then I'll see what happens at the next levels in the way. Looking at some of the others, cable, we've got the old tough nut again at 130. Oh, come on, get in. So cable's a bit more messier just purely because it can be a bit more volatile, but it's a bit similar. It's more liable to extend a bit further on rebounds and things like that than other pairs. But the key level, I said yesterday, was 129.50. We got up that, we tapped it, couldn't get through it. Then we had a break, and now look, straight after, it's holding. Okay, we've had a little move under here, but now we're back above it. So this 129.50, it's still in play again. Another main pivot line. We can't seem to stay below it for too long, but also we can't seem to stay above it for too long either. So we've got this sideways action going on until it gets resolved. As I say, 130, we tried picking through it yesterday afternoon. What did we get? 6, 7, 8 pips through it and then back below. So until we get a hold above here and we start building something like this, then this is more in a bit of a consolidation phase. And like cable likes to do, it's all about the big figures and half figures. Okay, 130.50 if we can hold above 130. But if we can't get through there, it just keeps the pressure on the downside. And I think this level is going to be really important. This 128, call it 128.50. I know we had that little extension a bit lower, but that didn't last long, and we're back above it. So I think this is a key level now down here. If we come down here pretty quickly, then it would up the odds that we're going to break, and we're going to see something lower, and then we're going to be, heading down 128s, which we know is a big level going back. So you got your range to play: 130.50, 128.50. Plenty of room in there to mess around in. 300 pips. Dollar CAD as well. Another one, can't get through this high area. We've had 3 goes now over the last few months. These two pretty close together, and we just can't get a hold above it. But we're not dipping back too far at the moment. Okay, but 139 again. That's really your marker, and here we are. Let's put it a bit shorter term. Here we are, just holding below it again. So this is another bit of a pivot point. While we hold below, it keeps these downside moves in play. If we're above, then we think about 139.50. This is one pair where whatever happened with the election, I thought we may continue this trend, because you know, a lot of this trend isn't the election. A lot of this trend is everything else going on with the US, with Canada and whatnot. So this is a bit significant, yesterday's move, because it's a step up from that low after the election. Okay, so again, we've got this reaction, reverse reaction, and then, you know, a bit of sideways, but this is a step up here. So if we do break above here and go and take this 139.50, that'll be the 3rd time in quick succession. That would indicate that there's a strong potential that we do break it this time, and if it goes, it's going to go. If that's the case, then we got the old target on that 140 area, and that's going to be a very interesting one. Given that these highs, 139.60, 70 is only, you know, 40 pips shy of that, I would question whether, if we break here, we go and take that out. I'm still maybe interested in tapping that for a quick scalp short on a first time, but I'll watch the price action. If we're doing a bit of a building up scenario where, you know, we get up to, you know, 139, 80s, come down to 50s, 80s, 50s, and we build and build, that would suggest we're going to be heading for a break. I'll be less inclined to try a short in that situation. We do have Canadian jobs today, so that could be a bit of a mover, depending on whether it's a wonky one or a good report. If it's a good report, then that's obviously going to put the downside pressure on, and I may be interested in that one for a bit of a dip buy, because I don't think it's going to change what the Bank of Canada are doing. So dip down to these lows, perhaps near 138s, I might be a bit tempted to go for that. And I think if that happens and we bounce from there, then I think 140s are pretty nailed on, in my opinion. Alexandra, you just turned up. Oh, mate, where you been? You missed all the fun. You missed all the fun. You missed the guest. Oh, you've missed it all, mate. I did talk about euro dollar. So please forgive me if I don't go back over that one again. No worries, mate. You can watch it on the replay. Right, what else we want to look at? I'm going to look at dollar China as well because of what's going on. It does seem like officials might be getting a bit more cautious or a bit more adventurous in their talking about the currency, given where we are now. This was obviously a very impulsive move that we saw here. Personally, I would like it higher, but I might come to the point where I'm not going to be picky. Again, it's done exactly the same thing as we've seen in other pairs. We had the move up, we've come down roughly 50%. We have taken some of that back. Obviously, what's going on with policy in China is a big part of that as well. Obviously, the Trump trade, as we call it, in terms of China being one of these biggest targets. So I expect a bit of volatility to remain in this one. But there are some indications that they won't be happy to let this go up too far. And that will form the basis of whether or where I may step in to try some shorts on this one. If we're up here, 728s, then, and they haven't said anything, I'm going to be, I think I'm going to start loading up with some shorts because I think that's where they may say enough's enough. And if they say that, then it's a pretty good indication. You don't get many central banks giving you the heads up where they want their currency to go to. Might as well look at dollar yen as well. This one's just slightly different. It is looking weaker. It looks like we're following yields as usual. You've always got to keep an eye on the yield chart. You can just see this move that we've got here. I'll just flick to the 10s quickly so you can see what I mean. Pretty much the same mirror image move that we've got here. So this one's on the yield bus at the moment. 152, it's been a bit wishy-washy of late. We'll need to see what happens if we get there. If it carves through without much fuss, then I'll probably reduce the scoring of this line. You know, I'll talk about you have levels and you score them. Which ones are your stronger ones? Well, that's why it's a big fat red one, because I think it's stronger than a lot of other levels. But if we come through this pretty quickly, I'll probably downgrade it to a normal pink line, because it will be it will show that we're not doing an awful lot around it. Under there, we've got this prior low 151 30s. Otherwise, we're going to be down at the 50 here, this old level 150.76, which has been a level all on its own already. So that could be a bit of a key point. We're not breaking anything yet, though. If you put a fib in from this low to this high, I think it's coming in round about there, in amongst that lot, 149, 148. I haven't as yet, because we keep making highs and I keep redrawing it and I get fed up doing it. So I'll put a fib on this one when we get a bit more closer to where it might be. But for now, yeah, this one is just a yield play. So if you're trading dollar yen, base what's happening on yields in terms of what's going on with this one. But there's always a point where the currency or dollar yen will run into its own levels and fundamentals, irrespective of what yields are doing. Okay, so you can follow it in the short term, but if it drags on and on and on, at some point people who are trading dollar yen are going to say, well, that moves too much for the fundamentals behind the currency. So irrespective of what US yields are doing, that's enough. And that's when you start to see the correlation just pausing or breaking down a bit. Euro sterling, I'm getting a bit twitchy about at the moment. I have been thinking about buying it. I haven't bought it yet. It's not looking all that great at the moment, but a level is a level until it's not. So if I do have a little nibble down here, then I'll probably be looking to reverse it if we do get a break of 83, because just this price action, you know, bounces are very weak. Price action is telling me that it may want to have a look to the downside, but you know, this is euro sterling. It can do that. It can suck you in to thinking it's going to go, and then you get a bounce like that. So if there's one thing that's going to cause a break, it'll be me going long. So I'll keep that in mind if you're in the chat room. But yeah, if I do have a little nibble down here, I will probably run it with a stop reverse somewhere below the figure, because I think if it does go now, it's going to have some legs, and we'll see where it wants to go to. At the very least, I need to put it on a wide chart because these levels are quite some way away. At the very least, I think, you know, 82.76 is the potential. So it's only, you know, 28 pips under the figure, but it could be significant to get down there. We've had lots of prior action down at that level. Don't ask me why. Market wants to go where the market wants to go. But that's probably a bit of a line in the sand. If we're under there, then we're probably heading to the low 82s. So that's why I'll look to go with a stop reverse on that one. Oh, right. Just looking at the clock. Oh, it's nearly half past already. So I've done a lot of waffling. I'm done for now. It's been a busy week. Hasn't been the best week trading for me. Not by a long shot. I had a few blunders through this week, but shit happens. That's trading. You can have all the best setups in the world and they still go wrong. So I hope you've had at least a better week than I have. We'll be back up and running next week. Obviously, don't forget to catch us later on the F.A.C.E show. Until then, thank you very much for coming to the Flow Show this week and every day. Have a great weekend, safe and peaceful weekend, and we'll see you on Monday.